Alrighty, everyone, we're going to go ahead and get kicked off for those that are in the room and again, attending online. Thank you all for coming to our next session of the Founder University series. Today, we're going to have Aliesha Balde talk to you about how to translate your startup idea to an audience of investors. This is, a lot of people have this kind of a nuanced view of what it is to raise capital. And a lot of that kind of comes down to telling the story, making the convincing pitch, as you guys heard many times, to potential investors. So in this workshop, Aliesha is going to cover a number of things, but some of the common mistakes founders make when they're pitching, the investor mindset, what's really driving their decision-making, what investors want to see and hear, and of course, ways to frame your company to increase investor interest. All these are really important components of this, and this is our third session, I believe, of the capital raising series of the Founder University. But before that, I do want to give a little bit of background about Aliesha. Aliesha is the founder of AB Consulting, a growth strategy and business coaching firm serving mission-driven founders and CEOs. The core philosophy of her work is growth on your terms. And she brings this to life by helping founders remove barriers to growth and identify growth strategies that are in alignment with their goals, mission, and values. Prior to her current work, Aliesha supported Fortune 500 companies at a global business management consulting firm, ran her own investment advisory practice, invested in startups at VU, and served as a startup ecosystem builder and startup advisor to the US State Department initiative in Silicon Valley. So without much further ado, Aliesha, please, thank you so much. Thank you for joining us, and I'm going to turn it over to you now.
Awesome. Thank you so much, Logan. Thank you for having me. And it's fun to hear yourself presented like as a preface. So that was fun. And hello to everybody that's here. I am excited to chat with you and talk about how to translate your startup for an investor audience. I think unless there's anything else, Logan, I'll go ahead and just jump right in. We'll do it. Sweet. Oh, let's see. That's how before I have a little bit of an intro that I'll provide myself, but I just want to get a sense of who's in the room. So I can't see the chat, but Logan is going to be the master facilitator here. And if you can just share what your company is, maybe what industry you're in, and if you're currently, where you're at in your business. So maybe like how many years you've been doing it. And I'll give like a couple of seconds for that to flow in. And then Logan, I'd love to hear kind of some responses, just so I get a sense of who's in the room, what are you working on, what are the problems you're facing. AI product development, pre-revenue, going live in a month, pharma, 20 plus years, healthcare.
And in the room, we also have a few folks. We have a couple of people who have been in their business for a few years to probably the better part of half a year at various stages of raising capital. Two technology companies, one in health tech, one's a CPG, a couple of different things in the room as well. And all interested in potentially raising capital or currently doing so.
Awesome. Thank you. And yeah, what I can see is like a lot of things that are in the really early stage, and also just a lot of subject matter expertise. So, and I'll get a little bit to the team element, which is where a lot of that will become incredibly valuable. Okay. Oop. So Logan already did me the favor of providing an introduction. I think maybe the fun things about me are I am a polyglot. I speak, I'm working on my 5th language. I'm living in Costa Rica currently. And I picked up a digital nomad lifestyle about a year ago. So 20 days from a year. What am I trying to say? In 20 days, it'll be a year. That's what I'm trying to say. And he already mentioned that the core of my work is really to help mission-driven founders chart their own path by turning their personal mission into profit and impact. And so I have a little bit just to kind of give some more context of my work, and then we'll jump right into the good stuff. But maybe just one other thing about my background is I worked in Silicon Valley, and I'm originally from California. And my background was with the US State Department initiative called Lions Africa. So I spent a lot of time with mission-driven companies who are predominantly based out of Africa, but many out of the US, who are struggling to fundraise and struggling to get people on board with their mission. And I saw that repeatedly, even with the venture fund and with some of the work that I was doing. And so that kind of is the impetus for how this business got started. Was there's lots of ways to grow. It doesn't have to just be VC. And so how can I help facilitate that process? So just a little bit about who I serve. These are people who are who feel a really strong inner drive to create a positive change. They're committed to their mission. So whether or not this particular company works, the next company would be something in the same field. These are highly ambitious people who have big visions about what's possible. They're invested in seeing their company and movement grow. And then they're often category creators in their market. So from a mission-driven perspective, it's often people that are like, I don't see this solution anywhere. I'm going to create it. And that comes with its own barriers, which is why I frame some of this conversation around what the issues are for specifically mission-driven founders. But it works for everyone. I mentioned this briefly already, but essentially the pathway that is often provided for companies that are just getting started is you go to an accelerator program, you raise venture capital. And what I should have added there is like, there's an expectation for an exit. Maybe you want to run a lifestyle business. Maybe you want your business to not necessarily hit 100 million, but you're also just as invested as there being a lot of impact in your business, right? So you're kind of splitting where you're putting, how you're quantifying growth. So what I help founders do is come up with growth strategies that match their values and their vision. That is anything from looking at venture capital to alternative capital, sales, growth strategies, grants, you name it. And so that's kind of how I help founders think through like what's possible for them in their business. And I do this in a growth system that is proprietary to my company. It's called the YATF growth system. And there's 3 pillars to this. One is growth positioning, which is going to be a lot of where the foundation for this conversation around pitching investors is going to be informed by. The second is growth strategy, which is, how are you actually getting to that next stage of growth? What are your goals, but also how do you want to get there and what's in alignment with you? And actually, just to go back to growth positioning, that's really just like, where do you sit in the market and how will you meet your customers? How do you differentiate? Really kind of just like that position setting. And I think of the analogy as like, I have a slingshot and like, let's pull that slingshot back. Let's find that target through growth strategy. And then the operational alignment is really that releasing and letting go and moving you in the direction towards where you're headed. Should have included an image of a slingshot, but you guys get the picture. So the goal of the session, what I want to help you guys do is raise more money. That's ultimately the goal. And to do that, it will be through this framework that I've kind of just prefaced that will help you translate your company for a mission-driven audience. Logan already kind of discussed some of the things that we'll discuss here, but we'll talk about what people get wrong, the investor mindset, how to translate the mission in investor terms, and then how to refine your positioning and messaging. As kind of being the cornerstone in the landing and like really technically what ends up being the problem. So I did see in the chat that some of you are fundraising. Some are pre-revenue. Yeah, can folks give me a sense like how much is this like your seed round? It must be seed, it must be pre-seed. If you don't mind just like popping in the chat. If you've even raised before, pre-seed. Pre-seed looking at 250K, okay. Pre-seed. Amazing. Awesome. Self-funding, pre-seed. Perfect. So then this will be really exciting. Seed 500K. Because as you're in the early stages of this, it will really help clarify a lot of what you're doing. And as you start to approach investors, how to approach investors is its own conversation. I'm not sure if you guys are discussing that in a separate session, but I do hope that's something that you guys are also discussing. Unfortunately, there's just not enough time to get into that with me today. But so we'll jump in from here. So I just want to have you guys imagine you're an investor, right? You are sitting behind your computer, you're getting, I don't know, let's say 50 LinkedIn messages a day with people saying, here's my deck, like, are you interested in investing? And some of them you're looking through, maybe you're taking somewhere between like 30 seconds to a minute and a half to kind of scan through to see if there's something there. Maybe you're taking the meeting and sometimes you're having between 5 to 10 meetings a day. So when you think about it from that perspective of who the investor is and kind of how they're getting inbounded with all of this information, all of these requests, they need to have a filter. They need to know, like, what am I looking for when I'm looking through your deck? So whether, and this is relevant whether it's just in your deck or even if you're having a meeting, but like they have a framework in mind and they're trying to match based on that framework. So keeping that in mind and kind of like that being the investor mindset as you're kind of starting to engage them, I want to start jumping into the common mistakes that founders make when pitching investors. So the first mistake that I see quite often is that it's unclear what you're actually doing. And what that means is, like, in 30 seconds, you couldn't tell me clearly what you actually do, the problem you solve. It takes a long time because maybe it's really technical, or maybe the industry is really complicated and like there's actually all these moving parts. And so it takes a long time to actually get to the point of what you do and why it would be valuable for the investor. And then other times the customer's pain point is just lost in the jargon. And so I have a really great example for you. I'll just say this, I have a couple of examples that I'll share from companies that I've either worked with directly or have worked with in some kind of like consulting capacity. So I do have their permission to share the slide. I have removed just kind of any information just for their own, just so that they have that kind of privacy protection. But with that said, here's an example of what it looks like for it to be really complicated. And I'm literally, this is in their deck, and this is the first sentence, right? X focuses on a HIPAA compliant technology to engage families and individuals in managing their health and social drivers of health in collaboration with healthcare and social service providers and payers to improve outcomes and efficiencies. These improved outcomes can also lead to reduced healthcare costs. I don't know what that is. So I've underlined the key points here that they're bringing to the surface, right? They're a technology, it's doing some kind of management for some people of their health, and it may help reduce healthcare costs. It's very unspecific. It's not clear what it is, what kind of health is it helping them manage, like what kind of healthcare issues, right? Like, it's super broad. It engages families and individuals. You could not get more broad than that. And it maybe helps lead to healthcare cost reduction, right? That's, if you're trying to sell this, it's incredibly hard to sell a maybe, right? It's unclear who this is for, and it's unclear what they'll get out of using this. And so to the point around, the message being unclear, oftentimes what I'll find is people that are like deep subject matter experts or just really passionate. It can get a little bit inflated the way that they talk about what they do. So that being kind of like example number one. And Logan, yeah, if at any point there's questions, like I'm happy to take them here as well. So common pitfall number two is trying to do too many things at once. What does that look like? You're trying to solve too many problems at the same time. Maybe you're like, here's this particular issue that we solve, and here's where we add value, but we also do this, and we also do this, and we also do this. And what that says to investors is you don't have focus. And it also says it's not clear how you actually intend to scale. Why is that? The pain point is your selling point, right? Like the pain point in your business is what people are transacting around. And if you're having multiple pain points that you're solving for with different products, that means you almost literally need to have specific messaging and marketing for each one. And from a scalability perspective, that slows down everything because it's a decentralized message. And then the other thing that it does, it just kind of signals that there's a lack of understanding of your customers' needs. So your customers are typically buying around, as I just mentioned, a singular pain point. And if you're unable to say what the most important pain point is, then it just means you haven't spent enough time with your customers to really figure out what that is. Because usually in the world of pain points, there's a hierarchy and you can figure out what that is. And I'm not saying that you wouldn't talk about maybe some of the other value that you bring to the company, some of the other value that customers are getting from what you're offering, but it should be very clear what that hierarchy of value looks like. So it should be like a vertical structure and not a horizontal structure. So what does that look like? Here's an example from another company. They do two things. They have a financial modeling tool for startups who want to, who maybe aren't so financially savvy, but don't have the funds to get a CFO. So that's kind of one offering that they have. But then they also do investor matching, and they have this kind of proprietary platform where they match investors with funders. Now, at a high level, it's like, yeah, okay, all of this makes sense for it to be in one space. But these are actually two different businesses, because the financial models is something that's like very B2C, right? You just need to sell to the customer, the startup who wants the tool. Investor matching is a marketplace. And so there's actually a different dynamic happening there where you need to bring in startups. You also need to bring in the investors, and you need to build the relationship, you need to build the value around the relationship between the two, so that they're actually like, oh yeah, I should come here to kind of continue, finding my investors. And so I think this just kind of highlights how it might seem like you're like, yeah, I'm selling one thing, but you're actually selling to two different audiences in this case, and around two different pain points. And so again, from a scalability perspective, that means the messaging is not clear. That means like the core of your business model is not clear. And typically you're fragmented in where your time and energy is being spent. And that just ends up taking away from how much money you could be making when you're focused. So the third common pitfall, this one I see all of them all the time, but this one ends up being a really big one. And I'm gonna make an assumption here, but I will touch on this briefly, that you all have a sense of like what the TAM, SAM, and SOM is, and I've kind of provided the definitions of them there below. But basically, when you're selling to an investor, you really have to get them excited, right? Like, again, given the context that we set, where it's like, I'm getting a lot of messages, I'm taking a lot of meetings, I need to find what I'm looking for. The investor needs to get really excited. And one of the ways to get them excited is to say, this is a massive market. And not only is it a massive market, but I can obtain enough of this market to hit 100 million in revenue. And so a lot of startups will kind of anchor themselves on that and focus their whole presentation on the vision, and almost exclusively on the vision. What that ends up doing is it distorts your story, because then you're over rotating yourself for like the fundraising process, instead of helping the investor see like, yes, there's a big potential here, but also if we get down to the very granular level, there is a human, not only even one human, there are many humans who have this problem on a day-to-day basis. They can't sleep at night. They're like, I just need something to solve this problem. And when they come across your work, they're like, oh yeah, I'm ready to buy that. That's exactly what I need. And so there's ultimately this tension between the vision. I put traction, but really it's the pain point that the customer experiences, which then is a reflection of traction, right? Like you'll have traction if enough people have the actual problem. And so in the presentations that I see for people that are pitching, what happens in that case is they'll paint so much of the story around the size of the market that the customer gets totally overshadowed. Oftentimes I'll even say like, who is your customer? Do they even have a problem? Where do they exist in this story? And the other thing that I often see, which is kind of crazy, is that the product itself will get lost. And so there's like a decentralization of what you're actually selling in order to try to emphasize how big the market is and how big the opportunity is. And so the magic there is really finding that balance between the two. And I'll get to that a little bit later in the presentation. But here's a couple of examples of what that looks like. So this is a company that I received a pitch deck from a few years ago. And in talking about the market, they started talking about the fourth industrial revolution. And sure, that is a market trend that's important, and that's something that perhaps is relevant to the overall story. But the reality is investors are humans, and this is so far removed from anything that's tactile, because this is just like a massive, I mean, you're talking about like decades of economic and human behavior shifts, right? And it's like, yes, fantastic, that's happening, but like bring me down to the actual pain point. And so this was pre-COVID, and the context for this company, just briefly, is that they're an education platform, we'll call it that. And so like, pre-COVID, even the messaging maybe wouldn't have resonated so much, but post-COVID, obviously then with the whole COVID storyline and everybody working from home and everyone going remote, that at least makes it more tactical and tangible, instead of kind of these massive framings around like what's happening with skill sets. So that's kind of one way where the framing of the market just gets like so distorted, where you don't see where the value is from an investor perspective. This example is about a shoe company that had a piece of technology in their shoe. And what happened was they ultimately had one slide about the shoe. And what was interesting about the shoe was that it was made from, like recyclable materials. They had one slide about the shoe, and then everything else was about the technology. And so it's like, fantastic, there's technology, but like what you're actually selling and who the people are buying the shoe, they're not buying the technology. Like this is more of a feature than it is the actual product. So then just to continue along here, this particular company, like I mentioned, they were, again, just kind of overemphasizing the technology. So there were maybe 3 slides about the technology that's really more of a feature to the shoe, and kind of decoupled themselves from the main story. And I think for a lot of investors, they do want to see technology, like something that's based in tech, but where you really want to be showing that there's value and where there's like the growth potential is in your core product, and not necessarily the features and the benefits of the core product. And I think it'll depend, but in this, the reason I say it depends, because for different softwares, some of them are super similar, and so there's some nuance there. But in this particular case, for the sake of this example, it totally kind of took the story and the narrative of their company in a very different direction, or in a direction that doesn't sell the opportunity in as big of a way as it would have been if they had just focused on the core product itself. So pitfall number 4 is the downplaying of yourself as the founder or the team. And what this looks like in action is that you're maybe talking about yourself in a way that kind of hides how much you've done. And it kind of doesn't fully provide context for how much you really are the person to develop the solution. And I'll give you an example. I was speaking with a founder from a VR company, and she is like the leader in her field doing B2B sales. And she was like trying to decide how to kind of frame her story. And only later in the conversation, I want to say maybe like 45 minutes into the conversation, did she mention that she wrote a white paper on the applications of VR for Oracle. And she's like, oh, I typically don't talk about that. And I was like, well, first of all, that's who you are and that's what you've done. So like, absolutely bring that to the forefront. But also it like establishes very, very deep domain expertise. And so leaving out that kind of information that would really help center you as the expert is something that I see quite often. And so, so that's one of the main issues. The other thing around team is that your team skill sets don't fit the gaps that you need. So maybe your CTO, excuse me, I'm thinking of an example here, but like maybe your CTO doesn't have all of the technical skill sets, right? Maybe they're like lacking skills in some AI technology development capabilities, and like so much of your business is focused on that, right? Like they know how to do this the core tech building, but like they're lacking some element of that. So excuse me, just as a rough example of what that could look like. The other thing is like your team might not exist. And as much as like there are solo founders that have been successful, companies aren't built without other humans. And so finding people who buy into your mission and your vision as soon as possible is such a foundational part of the success. Because not only does it mean that you have help, but it also means somebody else has bought into your vision. And so much of what an investor is looking for is like, who believes you, right? Who believes that you're right? Maybe it's your team, maybe it's through customers, maybe it's through investors, but they need to see that like other people, had a conversation with someone and they were like, yep, there's a there, let's go. And then the last is there's a team market or team solution mismatch. And that's a little bit of what I had already mentioned here around like the the skills not matching the solution you're building, but also there's team market too, right? And like, excuse me, this could be even for you as the founder that maybe it's not, maybe like where you need to be focusing is slightly different so that it better suits your skill sets or what you can actually practically produce and create or put into the market. And so here's an example, just blurred out this guy's face, don't mind him. This company has a pretty highly technical company. So they do, there's some element of generative AI technology being used here, but basically there's, what do they do? They're a software that gives property owners the ability to figure out how much electricity they're using in the building. And he may not need to have all of those technical skills as far as like knowing how to build out that technology and how to facilitate those, relationships. He may actually be the visionary, right? Because he even hears like predictive analytics at Udacity. We all know Udacity is like online learning, which is not to knock that the self-learning process, but who on your team has deep subject matter expertise? And in this case, it says our team, but it was literally just him. And so you want to be able to look, the investor wants to be able to look at your company, sense like where the skills you would need to make it successful, identify what they are, and then look at your team and say like, who's actually able to do that? And are they able to do it? And if that's not the case, where can you get the people, or in your pitch, can you describe how you're acquiring people to be able to help you do that? So common pitfall number 5 is not understanding the investor mindset. This is probably the thing that I talk about the absolute most because it's so fundamentally important for knowing how to engage in investor conversations. And mostly because there's a little bit of a misconception. What I find is people will talk about venture capital like it's a grant, but you're instead of just getting free money, like you have to give away equity or you're making some kind of exchange. And the reality is it's not that simple because equity, I think people think of it as like, oh, it's just a number on my cap table, or like it's just like some allocation in a document. But really what it is influence and its power and its control. And so you in bringing on venture capital is like, there are now people that have a say in the direction that your company goes to. And that's mostly due to the fact that VCs are money managers. So they have LPs that they're reporting to, and they're like, basically have a contractual relationship where they're talking with LPs and saying, if you give us this much money, we'll make you 3 to 10x money back by allocating it, right? And so the venture capitalists who are giving money away, I mean, they're not giving it away, but are making the investments, are then looking for companies that have the potential to make that 3 to 10x. And I'll get into this a little bit later, but also that like just have a clear path to profitability or some form of exit. And so just to contextualize that, they're ultimately putting a number value on the entrepreneur's ability to execute in a way that will make them more money. And so what I find is that founders will approach investors like almost like, you should give me money because this idea is so cool. And it's like, well, this is a really cool idea, but it doesn't fit the profile of what we're doing. And so therefore it doesn't make it a good investment opportunity. And so I think just even having that reframe mentally for founders is a profound shift in how you would approach your investor conversations. And then the last point being kind of this like, it's my baby point of view. And what that means is, as the founder, you typically are the one with the mission and the vision, and you're driving the business forward in a way that you're pushing the company forward, right? And because you're so attached to the story and your involvement in the story, and oftentimes the founders themselves are the ones that experience the problem, and so they can speak about it from that first person perspective. Sometimes they're not. And so then sometimes they become kind of this third focal point in the story between, you know, what you're trying to do and then who you're selling it to. And then there's like the investor as kind of that third pillar. And so what I find founders will do is they'll kind of over rotate in their own how do I want to say this, like their own role in the transaction. And to provide some context around that, it's like they become the center of the story instead of at some point shifting the focus of the story to their customers and their customers' needs and their customers' pain points. Because at the end of the day, the investors are like, yes, they want to see your enthusiasm. They want to see that you can do this. They want to see the qualifications that you have. But they need to see that other people care. They need to see that other people have bought in. They need to see that other people are just as excited about it as you are. And so again, it's super important to bring that passion and that energy, but balancing that or bringing more balance to the pain point that the customer's experiencing into that conversation helps give it some credibility and some backing. So I think this is a good point to pause and just kind of get a read from the room. Like, do you guys see yourselves in any of those examples? And
couple of nods from the room, and yes, some yeses on the chat.
Sweet. I'd love to hear like which one resonated with you most.
In the room, we have a founder who it kind of alludes to the team thing you mentioned, having kind of a sense of imposter syndrome and not necessarily not sure how to draw attention to the team's skill set or where they're at.
I absolutely hear that. And it's for the team part, it's hard because it can feel like you're bragging. But again, if we kind of get into the investor's mindset where it's like, I only have so much time. I really need to see really quickly, does this match? It's like you only have so much time. And so you almost as a requirement to get your business in front of, to get into that next meeting, right? Or to even like get to that, say you're in the first meeting, getting to that second meeting, you really have to sell like why you guys are the people. Because in as much as people, as investors are investing in the idea, they're actually more, it depends on the company, but many of them are actually more focused on the human. Who is doing this? Because you're the one that's executing that. And so the more that you can show that you're the person, and the thing about that too is there's often, I think we like to think that our ideas are unique to us, and many times they are, right? But there's often maybe another person, it could even be somewhere else in the world that's also building something else similar or something tangentially related. And so we have to be able to quickly help an investor see, even if potentially they're having a conversation with another company that's doing something similar, they should absolutely forget that person because you're more qualified to do the work. And I'll even just provide an example. When I was at VU, robotics kitchens were everywhere, like not everywhere, but there were so many people pitching like, oh, I'm going to create this robotic kitchen thing for this and robotics kitchen for that. And at the time I was like, wow, I literally have seen 5 of them, but there was really only one founder that I was like, oh, you know, if somebody was going to be successful doing this, it would probably be this person based on their background, based on what they've been able to do, based on how it seems like they are really prepared to kind of take on the space, based on the customer reviews, based on how much traction they've gotten so far, right? Like, so a lot of, I think I'm just saying this to say, I really want to empower founders to like, if you're never really, if you're typically not like bragging about yourself, like this is the time to do it. If you were going to do it, like this is the time to really lean into it and make sure that it's clear that you're the person to do this. I just want to track back here to a couple of the other ones. So founder ego and forgetting the customer journey. It's such a big one. You're definitely not alone in that. So yes, being able to provide that balance between the two. Team skill set, we talked about. Pitfall number 2, we have 2 amazing lead compounds. Exactly. So being able to decide which one is your lead product or what's like actually, and the thing about that, especially if you have multiple value propositions, is to deter, like a quick way to kind of navigate that for yourself is which one has the most traction? Where are you even getting most excited? Which one do you get most excited talking about? Where are people buying? Honestly, at the end of the day, it's like who's resonating the most with one or the other. There's definitely more to the determining process than that, but I think if I were just to give you like a quick 1-2 about how to think about that, that's how I would think about it, is like what's bringing in the most money? What are you most excited to talk about? What do people talk about the most when, or like what are they most excited about to talk to you about? Yeah, the investor mindset. So just for the question around, do you advise pointing out gaps in skills and hitting that head on? I think it depends. It depends where you're at in the conversation with the investor too. If it's the first meeting, you really want to just like be bragging. If there's like a highly obvious not error, but like gap. So it's like, I have a technical business and I don't have a CTO, then like, yeah, address that head on, absolutely, and talk about what you're doing. But if it's something that's like maybe less obvious and really is maybe something that only you would know, I don't think in the first meeting you need to bring it up, just again to kind of keep that excitement going. But my inclination is typically like just be transparent, because these are things that can be solved. And then you also want to just kind of establish a relationship of trust with your investor, because this is a 10-year relationship, guys. Like these guys they're looking to invest and they're looking to see you through to that big exit. So you want to kind of determine the kind of relationship you want to establish from the get-go.
Awesome. Well, 1 second, I'll put the mic on. Aliesha, we have a question here in the room. I'm going to go ahead and change the mic so that they can, just so that they can be more clear when they ask. So 1 sec.
Yeah, can you hear me, Aliesha?
Kind of. Let's give it a shot, and then I'll let you know if I can't.
All right. So I've got a business where we essentially are replacing chemotherapy for men dying of prostate cancer. Okay. So it's a new treatment that was just recently FDA approved in the US. So
Congratulations.
I'm really, really excited about it. We're building the first theranostics facility here in Las Vegas. And then the goal is to grow nationwide. Curing cancer is not my forte. It is my chief medical officer, right? He is the one that's doing that. I have a really big meeting with a capital company up on the 6th. So when you talk about as the CEO of the company, I do have a certain amount of imposter syndrome because, it's a very specific thing that we're doing. Now I've got the relationship with him and I've built the relationship and he trusts me then to execute on the vision. But how would you position that when he's got the majority of the problem solving, but I'm the one who has to drive the business and build awareness and all of those things?
I love this question. Well, so I didn't catch your name, but to address that point, I would say a couple of things. If you're the CEO, you're the CEO for a reason. And I know that you're driving the company. Oftentimes what that means, and I imagine this is what you're doing, is you are like setting the creative direction. Maybe you have more of the business skill sets that you're bringing to the table. Maybe you're the one that's like facilitating the relationships and like bringing in the leads to the business. And so I think I just want to offer that, like, you're the CEO for a reason, right? And so I want to just invite you to stand firmly in your role and your authority in that. And also just to kind of invite, like, I guess I think about it like Steve Jobs, where it's like hire the best people and let them do what they do. And so because they're the experts in that space. And so it's a level of like really just being clear of like your role, your authority, what you bring to the table. Like you're not going to have the deep medical expertise. That's totally okay. It's absolutely important that you have somebody that has that. And the fact that you do is like huge, because that will get you so much further. But as far as like if you're in a pitch meeting, like you would absolutely want both of you, right? Because then you're talking about the strategic direction of the business. You're talking about how you're tapping into the customer bases and understanding their core needs, right? Like you're talking about it from the perspective of, here's how we're going to drive the business, here's how we're going to have an impact, and here is like our vision for how we're going to transform this industry. And then the subject matter expert is going to say like all of that is, I mean, and what I mean by that is going to agree with you and then say, here's tactically what that looks like, and here's why we're going to be able to do that. So I hope this answers your question. And I think, again, I just want to invite, like, you know, again, stepping into your authority in your position and thinking about, like, not only do you want this particular CMO to be a rock star, but everybody on your team, right? Like the goal would be that you have everybody on your team really being deep subject matter experts. And you're a facilitator. You're a facilitator of all of that in order to help meet the goal that you have of fundraising and ultimately running this really amazing business. So yeah, I'll pause just to kind of get your reaction and then I'll move on.
Yes, thank you very much. I appreciate that. Thank you.
Absolutely. You got this. Where we left off was the conversation around the investor mindset. And I want to double click here because it's just so important to really understand how investors are thinking about the investment opportunities as they come to their desk. So we'll jump right in. And this graph, I think, really highlights how different venture capital is from any other asset class. And again, I think I just want to remind folks that, like, the venture capital is not grants, it's not free money. You should think about it more as if someone is who's investing in the stock market, right? Like, you're looking at your options, you're seeing like what's going to give me the highest return. But in this case, the risk is so much greater for the LPs and also for the venture capitalists themselves. And so, you know, and just for kind of some reference, so cash being your lowest risk, lowest return. So if you have $10,000 sitting in a checking account or a savings account, the return you're getting on that is pretty low. And then as you work your way up to government bonds or real estate, as you put money into those assets, you'd see a higher return rate. And so again, I think what I mentioned earlier is venture capital, the fund managers themselves are looking to 10x their portfolio. And so, 1,000% increase on return on investment is incredibly lucrative, but again, kind of makes this such a speculative market. Like you're betting on people and their ability to execute, and not only their ability to execute, but their ability to execute profitably. And so again, it's a high risk, high reward business. And the VCs are really thinking about this as capital allocators. They have a certain amount of money and there's only certain places, there's a certain number of places that they can allocate it. And then that's it. And so this next slide will really help explain that. Here's an example of a $10 million fund. And I'm going to walk you through the structure just so that it's clear, again, how the investor's thinking about the meeting that they're having, right? Like you get one meeting with an investor. This is the frame of mind that they have. So let's say, for example, you have a $10 million fund. In that first year, well, even before I get to that, the way that funds deploy capital is different. So some companies may have a $10 million fund and just invest $100,000 checks until they've exhausted the 10 million. Others might do something that's more like this fund, where the first year they'll make $100,000 checks just to kind of, you know, see how those companies are doing, just to kind of get that first bite in. And then they'll save the rest of their fund to double down on the ones that are successful. So you can see here, let's say this is year one of the fund. They had, let's say, 500 meetings with companies, and they found 10 that they liked, that they thought could return their portfolio. So they invested $100,000 in those 10 companies. That's an allocation of $1 million. And then over the course of that year, 5 of the companies die. 2 of them are doing okay, and so they want to re-up. And maybe not 5 of the companies die, but maybe 5 of them either die or the fund is no longer interested in supporting their growth because it's just clear. They've gotten more clarity as far as like what's happening in that dynamic. And then, you know, again, there maybe are some companies that are doing okay, but they didn't maybe want to lead the round, or for whatever reason, they didn't want to make such a sizable investment. So they invest 500K. So then there's 2 companies in the portfolio that now have a 500K allocation. And then there's 3 companies that the fund is bullish about. They're super excited about where they're headed. They're, maybe want to be the lead investor, or, they just want to maintain their ownership percentage. So they went with the million for round 2. And then for round 2, or we can call it year 2. And then for the 3rd year, maybe there's, again, 2 companies that either died or no longer were viable investment options for the fund. Again, they have a limitation of 5 million. So they have to be really specific and clear about how they're going to allocate that. And so in this case, one of the companies they decided to double down on again, up to $1 million. So maybe didn't want to do too much more, but still wanted to kind of maintain the ownership that they had before. And then for 2 companies, again, let's just say for the sake of the example, they wanted to continue to be the lead investor, and they're really bullish about these companies and the founders. And so they invested $2 million in each of them. So what you can see from this is like the return multiple and the capital return, and basically how much money the fund would get on if there's a liquidity event, basically, which just means that there was an exit, the company exited. Either through an acquisition, they IPO'd. Those are usually the biggest 2. And then at the bottom, you can see this exit value, which kind of outlines how much the fund would get if they retained their percent ownership. So again, you're trying to maintain that 10% ownership. It could be different for different funds, but in this case, they wanted that 10% allocation. And so just again, to kind of zoom back out, basically this fund had $10 million to allocate, but they were only looking at these 10 companies, and they only used that to double down on their portfolio. They weren't looking for other companies to invest in. They were like, these are our bets. So you can see how exclusive and how like really targeted venture capitalists are when it comes to how they invest their money. Because one, if you only have 10 bets over a 3-year period, you have to be really sure that the 10 that you invest in are the best of the best of the best and can return the fund. So as I've mentioned down here, the average for fund managers is they are either able to return the fund or they 3x it, but the goal is to be able to 10x the fund and get as much money back. Or I shouldn't say 10x the fund, but you want each company to be able to 10x the money that you put into it, which in turn would make up for all of the investments made across the fund. So, right, you want to try and get back to level, because at the end of the day, you have to give your money back to the LPs plus whatever extra you got. And then as the venture capitalist, you have your salary, and then you're getting your 20% typically of whatever the fund is able to raise, not raise, but whatever the fund is able to make. So this, I think, is a really important thing to understand, because it's a numbers game for investors. And so they have to be really clear about who they're investing in and why. And so on the founder side, it really challenges you to be really, really clear about, am I one of these 10? Again, each fund will have its own structure, but the foundational question being, can I fit this fund's portfolio? Am I a right fit for them? Which is, again, this is not quite part of this conversation, but it leads to a whole broader conversation around how to manage those power dynamics and how to really position yourself to get into funds that make the most sense for you, right? So you want to make sure also that you're doing your due diligence and making sure that it makes sense for you, so that you're not wasting your time and you're not wasting the investor's time. So to kind of close out here on the investor point of view, I've kind of mentioned this before, but you should really think about venture capital as like high stakes gambling. And so again, not grants, not free money. These are people that are gambling, and you are the person that they are betting on. Venture capitalists are managing money for LPs. That's their primary role. And so regardless of what they do, right? So, I mean, they need to help the founder. They need to be along for the ride. These are 10-year relationships typically. But I think it's just really important to emphasize the fact that like their number one job is to manage somebody else's money. Their second job is to make sure that you can return that money to investors. As you saw, there's only so many bets that they can make. So it's part of the reason why you have kind of this like scarcity feeling when you're talking to some funds, or why they're like really, really selective. And yeah, as I mentioned, some of those bets needs to return the fund or up to 10 exit. Yeah, I mentioned this already as well. So you need one of the companies to be the moonshot. You need one of the companies to be the Ubers or the yeah, you know what I'm talking about, the Twitters of the world. And the way that they do this, and I've mentioned this before as well, is it's pattern matching. It's very clear what you're looking for, and so when you see it, you know that that's the company worth having additional conversations with. And then the other thing, which I think like the founders can't really have so much of an influence on, but it's just good to know, is that the VC ecosystem is really small. Everybody knows each other and everybody's trying to get into the best deals, right? So it's like, oh, there's this really great deal, which meaning like there's a really great company. How do we become a part of that? And often they'll say like, oh, well, who else is investing in you? Because they want to know who else also believes in you. And so this kind of goes back to my earlier comments around, you know, who are you getting to buy into your vision? Is it your team members? Is it your customers, right? Like it's really all about like persuading people to be a part of something that could really be transformative and make a lot of people a lot of money. And I think it's for that reason Adam Neumann, the CEO of WeWork, was so successful. And I think that's why they were even willing to give him additional money after everything that happened with WeWork, is because he understands this part of the game. So with all of that being said, I really want to make sure that it's clear what investors want to see and hear. And you'll hear a lot of things. Some things are going to just be repetitive. Other things are just kind of not really what investors are looking for. And so I just want to distill this down into 6 really simple key points. The first thing, so these are the 6 things. The first thing is that your customers have a real problem and you're solving it, right? So again, back to the customer pain point, back to like what pain point are you facilitating transactions around? The second is the solution to that problem can scale. So not only like 4 or 5 people will buy it, but if you put a growth engine behind it, thousands of people will buy it. Well, and I say that with some nuance in that like you may not even need that many if you're like a B2B company to be able to hit certain revenues depending on how your pricing works. But all of that to say that like, do multiple people have this problem, and can you get them all on board and to grow the business? The third is the size of the market for the problem that you have. It needs to be massive. And are you positioned to capture it? Meaning there are multiple people that are likely solving the problem that you have, maybe in some kind of different way, or maybe you have a really unique approach. But all of that to say that there's the size of the market is large. How much of that can you capture? And can you demonstrate that you'll be able to do that? And then the fourth is you and your team are the ones to do this, right? Like why you? And I talked about this in the earlier part, right? Like really being clear about why the investor should be bullish about you, the human that you are, and what the way that you're thinking about this and the way that you're approaching this. So that, you know, again, it's about getting the confidence of investors that you're the person. And number 5 is if VCs invest, how will you make it clear to them that you are making them money? So a lot of this will really come down to like the framing of the vision and your core problem, and like being able to demonstrate how you capture that market over a period of time. But again, like that's ultimately what investors are looking for. They care about impact as well. And especially if it's in a space that is ready to be disrupted or can be disrupted. But at the end of the day, again, right, these guys have LPs that are expecting some return. And so you have to demonstrate that you'll make them some money in this process. And then the last thing being that you have proof that people love you, and that's your customers and other investors, as I've mentioned before, also, and your team members, but really showing that you have traction. And if you're pre-seed, that again, just even small indications of like people nodding their head to you and saying like, yes, this is right. Like what you're onto is something that either I'm willing to buy when it's ready or something along those lines. So that could even be like newsletter signups or wait lists, right? Like it doesn't have to be actual transactions, but demonstrating that like people have this problem, you're saying that you can solve it, and they're like, yeah, okay, I can agree with kind of what the direction that you're moving in, and I'd want to be a part of that. So again, these are really the core 6 things. And I want to kind of share how some of the pain points that I mentioned during the first part of the presentation really map to those 6 things that investors are looking for, because it's here that you can really see like, okay, if you're not checking the box for all of these, or even half of them, I couldn't tell you the number, right? Like for some investors, it's more specific than others, but if you saw yourself in a lot of those examples that I shared, and those are really the things that investors are looking for, then, you know, it would make sense that after a first meeting, an investor would say like, you know, thank you, but just keep us posted on your progress, or maybe even never respond. I know that's pretty common also. But just to kind of briefly walk through this. So investors are looking for, do you have a problem? And where founders miss the mark is like, it's unclear what you're doing. Can it scale? If you're trying to do too many things at once, it is immediate indication that like, yeah, you haven't quite figured out how to tap into your target market here. Is the market big enough? Again, we talked about like this actually being a more of an over rotation problem. So like, yes, the market's big enough, but then only focusing on the fact that the market's big enough. Are you the one to build it? We talked about how founders often downplay themselves and their team. How will investors make money? Again, not understanding the investor mindset and being able to speak to that desire and what they're looking for. And then number 6, do you have any proof? And so then that's making it all about you. But I think what I called it earlier was, it's my baby, right? Like this is how I'm talking about it and what I'm doing, like putting you at the center of it. And so I hope it's really helpful to kind of see it in this way that, you know, these things are all very correlated. And so if you can fix the issues of where founders hit the mark, you increase the willingness of investors to have follow-on conversations. And I say that because there's the due diligence process, and like there's all these other steps that continue down the process to make sure to get investors, or that investors have as kind of like checkpoints along the way. But if you can handle and manage these parts of your pitch, then it really puts you ahead of, I think, other companies that maybe are in your field, or just generally like people that are reaching out, right? Like it gives you some competitive advantage in that you understand how this works, you understand what they're looking for. So there's something that I do with the startups that I work with and the companies that I work with, because it's not just startups, that really helps to alleviate all of these issues. And it's essentially a growth positioning formula. And I mentioned it at the beginning as far as like the framework that I use when I work with companies. But this framework essentially solves for all of the things that I've mentioned. And yeah, and it's essentially rooted in your customer empathy. Now, the reason this growth positioning exercise is rooted in the customer is because at the end of the day, it is the most, like your customers are the most important part of your business, because they are the ones that are giving you the money, right? They're the ones that are proving that like you solve a problem. And if you start thinking about your business as, what's the pain point I'm solving? Can I transact around this? It really helps you to then shift your focus to solving the problem and making sure that they're constantly being served. So I won't read this, but I think what I'll just pull out from what, you know, Bezos mentioned, who is known to be one of the most customer-centric CEOs currently. And you know, what he says is the most important single thing to focus on obsessively is our customer. And again, it's due to what I was just sharing, which is your customers are your buyers. And so and I think this is where a lot of people get confused. It's like, I'm raising money. And it's like, okay, great. But like, you're ultimately raising money because you have to come back to your customers anyway. So the sooner you can be customer focused and really help get them on board and engaged, the better, because then your mindset's already focusing on your customer, and you're not going to go through the pains of being investor focused and then realizing like, oh shoot, yeah, the business is the customer base. So this is going to look super simple, and it is really simple, but it's really profound. And so how you position your company for growth is by doing two things, right? And I think, you know, over the course of this conversation, I've mentioned that like in most cases, there's kind of this over rotation on vision. In some cases, especially when pitching, I found that there are people that don't focus enough on the vision. That's less often the case, but it does happen. And so as a founder, where your story, where your presentation, where your pitch is, where your messaging is, all of that sits at the intersection of the two. And again, this is a really simplistic demonstration. There's a number of exercises to kind of help really figure out what that is, because it's a bit of a merging of narrative. It's a merging of ideas. It's a merging of needs, wants, and desires. And so really finding like, where does that sit? Does a couple of things, right? So it gives you that clarity, and it centers you around that fundamental pain point, like I mentioned, for constraint or for roadblock number one, which is like not having clarity about what you're doing, right? Like something like this makes it super, super clear what that point of intersection is. It makes it clear what the pain point is, so you're not getting caught between two different potential value propositions, right? It helps you really narrow in on one and figure out what the prioritization is. It helps to create balance between your vision and your customer needs when you're telling the story. So for point number three, like really helps balance that out, because you're taking both into consideration as you craft this narrative. And then I'm trying to remember what number four is, but for your team, yeah, I mean, again, it does the same thing where your vision, it does the same balancing out. And so you still do have to kind of articulate and be bullish about who you are and what you're doing. But again, it kind of helps to balance out where the prioritization of that is in the crafting of that narrative. For the fifth one, understanding the investor point of view, this solves that, because you're bringing your customer's needs into the story right out the gate. So you're not losing that, and you're not over focusing on the vision, which then means you're getting to that pain point, which then means you're speaking more clearly about the transaction that you're facilitating, the pain point that you're transacting around. And then for number six, that over focusing on the founder and the founder's story, again, creates that balance and that equilibrium. So, and what I've done when I do this exercise with companies, what we find is that there's a shift of the business. And what it does too is help create more clarity for how to accelerate your growth. Because once you've kind of found that sweet spot, and you're doing it in a way that you're centering your customer base, but you're doing it from a place of where you are, again, back to that like slingshot analogy, like you're really pulling that back and kind of getting that focus so that it propels you further. And so, you know, I've been talking about positioning a bit here, just to kind of be extra clear about what it means. It's the unique value that a brand presents to its customers, right? So it's like, how are you speaking to your customers? How do customers see you in their mind? And I've talked about some of the things that it clarifies, but just to kind of reiterate some of these points, it helps get clear about where you sit in the market. So again, when you find that equilibrium between the two sides, it just becomes very clear where you sit and how you're different from others. And it does so in a way that doesn't center your competitors. You're that way. And, you know, for pitching's sake, sometimes you might say like, oh, there was a company that I was familiar with called Paystack, and they were like, we're the Stripe for Africa. So like, you might use some of these analogies just for the sake of like helping people understand what you do. But in doing the exercise, it really helps to create a foundation of your own business identity, and it centers your customers in the process. And then what it also does is give you focus. So organizationally, like we mentioned for number 2, where it's like you have maybe multiple value propositions that you're trying to figure out what you really solve for. It really helps you get that focus. And then the thing that comes from this, so like once you've done this positioning work, it gives you a framework for your messaging. And your messaging is where all of your sales communication will come from. It's where your marketing communication will come from, and any other maybe comms or PR work will all come from this foundational framework that you've gotten from really getting your positioning down and clear. That's just on the non-investor side of things, but on the investor side of things, if you're pitching a company, then it gives you that messaging and that clarity of message for the investor audience. The other thing that it helps do is give you pricing on clarity on pricing. And just for the sake of time, I won't get into that too much. But again, so these are all of the benefits that you really get from getting your positioning really clear, especially in the early days. And so when it comes to pitching and speaking to an investor, here's how that kind of plays out. So there's an article by Scott Hartley, who's from Everywhere Ventures, and he talks about kind of like finding that balance between vision, traction and execution, and vision, and when speaking to investors, because is 2 sides to the coin. Now, having done a positioning exercise, right, you'll already kind of be centered in what you do. And so the overall story and kind of like structure of the business and the business framework and story will be really clear, so that when you go into pitching, you can start with the big vision, but you, again, have enough of the traction and execution at the forefront of your story that it just like streamlines into that process. And it's an outside hourglass, because traction and execution is narrow, right? You're talking about your customers. Vision is big and massive and like kind of intangible, but like when you start getting really specific and narrow and like literally, this is John who came to my website and bought this thing, right? Like that's very tactical, that's very present. And so that's why it kind of narrows in. But then of course, wanting to close out with vision also, again, to maintain that excitement. And then that's where you'd bring in like the team and some of the other elements of the discussion, and like how much money you're able to make investors and elements of that sort. And so then that's kind of an example of like how that could play out as you're pitching. So we talked about a lot today, and we had a bit of an interruption. And so, if you've made it this far, awesome. I hope that you've been finding this super valuable. I'll just close out with a bit of a summary of what we talked about. So the first being, most of the core issues that founders have when they're pitching can be solved using a positioning framework. And I talked about how and why that is. I talked about the investor mindset and how knowing that and understanding that can really help you with how you communicate with investors and how you, and how like positioning also kind of ties into being able to inform like how you're talking about what investors actually want to see, which is ultimately they want to see how you're going to make money. I mean, I didn't say this explicitly, but like it comes down to getting really simple and clear and finding that balance between vision, customer pain point, and traction, right? And so like the simplicity and focus and clarity that you get from positioning ties into the story where you can balance vision and customer pain point and traction, which again, just helps you communicate your business with clarity and it can really move you further along in the investment process because you have that clarity and you're able to communicate with precision. And I mentioned this, but the same exercise works for sales and marketing. So if you were not fundraising, but just wanted to, like double down on sales, the same thing will get you the same result. Again, because you're focusing on your customer and you're centering your customer. That being said, there's always, depending on your company, there's always the question of who do you raise from first? Do you need to raise from investors now? Could you start what I like to call like raising from your customers, meaning instead of trying to go out and spend the time and energy on getting in front of an investor audience, to spend more time with your customers, get more clarity about what they need, get more time, better understand their pains and their wishes and their desires. So I think it's always a question I like to pose, and I wanted to save that for the end because I think it's fundamentally a question to be considered. It will depend on your company, but it's something to think about. So the last thing, I am running a growth positioning workshop next Wednesday. I guess not Wednesdays, but 2 Wednesdays from now. And I have a few spots available. If you're interested in learning how to do this for your company and want to work on that together, you can shoot me a DM, add me on LinkedIn, shoot me a DM, and I can give you some more information and we'll hop on a call and kind of discuss what that would look like. And then if you wanted to have any more information or you want to stay in touch, there's a couple of things that I can, share with you. The first is I have a 2-part webinar series, not webinar series. I guess it's a webinar series on YouTube. So this is from my previous company. So it's not branded my current company brand, but it's something that I did a few years ago, pretty much right after I left the fund. So it's a 2-part series to really help founders understand the investment, the mindset of an investor. And I get into a lot more detail. It's about 2 hours of content. So feel free to look me up on YouTube, and it's there, or you can just type in Think Like a VC Part 1 and Part 2. The other way you can keep in touch is to sign up for my newsletter. I have a newsletter that I send out pretty regularly with kind of updates and things that I'm making available, and other things that are going on. And I also share like other workshops and other kind of like consulting engagements that are available. And you can find that on my website. So if you go to AlieshaBalde.com, on the right-hand side, there is a link to the newsletter, and you can sign up, super easy. And then lastly, where I spend most of my time is LinkedIn. And so you can add me, we can connect there. If you have any questions, feel free to reach out. I'm pretty responsive. If I'm not responsive, please just be patient. I'll get back to you as soon as I can. And yeah, and that being said, yeah, reach out. I'm happy to help. I hope you guys found this helpful. If there's anything here, especially for the second section that you had additional questions on, and wanted to shoot me some questions as like a follow-up, I'd be happy to chat, or I'd be happy to, respond via any of these platforms. Now would be the Q&A session. So I'm bummed I won't be able to hear your questions, but like I said, feel free to reach out, and yeah, we'll be in touch. Good luck.
Thank you so much, everybody, for joining us today. Our next presentation is next week. And Logan, did you already announce that?
I did. I don't know. I'm assuming it's in our next session of the Raising Capital series. Do you know who our speaker is at this point?
Yeah, we have 2 speakers. We have Leith Martin, who's presenting on due diligence, and then we have JD Peters, and he'll be talking about cleaning your cap tables. So 2 really great sessions, great for ending out the capital raising segment of our Founding University program.
Absolutely. Those are really important, and it can be kind of technical sessions. So if you are currently raising capital, those are unmissable sessions for you, or at least join in while watch the recording on the platform later. Thanks, Audrey. Everyone, thank you so much for joining in person and online. We will see you next week.